Hello, everybody. Welcome to Intermediate Accounting video walkthrough for problem 15.4. This is from the textbook Intermediate Accounting 17th edition, authors Don Kiso, Jerry Weingart, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons, or Wiley. All rights are reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 through 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, let's get the accounting party started. Right over here, so we've got stock transactions. So this is problem 15-4. So Celis Corporation's charter authorize the issuance of 100,000 shares of $10 par value common and 50,000 shares of $50 preferred stock. The following transactions involve the issuance of shares of stock were completed. Each transaction is independent of the others. Okay, so we issued a $10,000 9% bond payable at par and gave as a bonus 1 share of preferred stock, which at that time was selling for 106 per share. Okay, so in reality, this is not a bond payable being issued at par. So when we have the amount of cash that we're going to be receiving, so the cash we're going to receive is going to be 10,000 because the share is being issued, the bond is being issued at par. We're always going to be recording the bond payable at the face value. Now, in addition to the bond payable, we're giving 1 share of preferred stock. So we're going to have preferred stock at par value. And then we're going to have additional paid in capital preferred stock. And so we're going to first go ahead, if it's trading at 106, basically this is going to be par value for the preferred is 50. And so the difference between 106 minus 50 is going to be 56. Now, when I look at this, in order to make this balance, I need a debit of 106. What is this going to go to? Well, since this really this almost kind of now seems like, in terms of this bond, is that this is going to end up being a discount on bonds payable. And again, this is to reflect the fact that we gave a share of a preferred stock, even though the amount is relatively de minimis. This is how we're going to go through and record the transaction. Number 2, we issued 500 shares of common stock for equipment. The equipment had been appraised at $7,100. The seller's book value was $6,200. The most recent market price of the common stock is $16 per share. When we're getting or when we're giving up stock for equipment, we never look at the book value of the seller. Rather, what we're going to do is we're either going to be looking at the appraised value or of the market price. So when we see the $16 per share, that may be the best possible indication, mainly because if there's an actively traded market, and that's really what the key is here. If the most recent market price is $16 per share, that indicates that in fact it is and something that's in an active market. So in this case over here, we'll probably go ahead and use basically the market price per share. So I'm receiving equipment, and the way I'm going to value that is by taking 16 times 500 for a total of 8,000. The next thing I'm going to go ahead and do is I'm going to go ahead and record my common stock. I'm giving up common stock at par. And many of you have already watched this video or seen these videos. You would never, ever, ever have a common stock par value of $10 per share for many different reasons. So this is going to be 500 times 10. And then you would have additional paid in capital common stock for the difference, or for 3,000. Okay, so this would be for number 2. This is for number 1. For number 3, we issued 375 shares of common and 100 shares of preferred for a lump sum amounting to $10,800. The common had been selling at 14 and the preferred had been selling at 65. So for this particular question, what we're going to kind of go through and do is we're going to kind of say, well, what's the total value that we're giving up? So for the common stock, the number of shares that we're giving up is 375. And for the preferred stock, we're giving up 100 shares. So the price per share, the common had been selling at 14 and the preferred at 65. So my total so right over here, when I look at this, the total value of the shares that we're giving up is 11,750. So given that the amount, though, that we're receiving is a lump sum of 10,008, what I would want to go through and do is to figure out my percentage of total when it comes to these right over here. So the amount that the common stock represents of this total market value is going to be 5,250 divided by 11,750. This over here is going to be 55%, or this is what's going to be equaling up to 100%. So I first go through and do these each as a percentage. Then what I'm going to do is I'm going to go ahead and take the new price. So this is 5,250 divided by 11,750. This is 6,500 divided by 11,750. So what I'm now going to go ahead and do is I'm going to take the amount of the purchase price, or basically to say the lump sum. The lump sum was 10,800. What I'm going to do is I'm going to take the percentage of total, multiply it by the lump sum, and this is going to give me my allocation for each. Okay, so now that I've figured out my allocation for each, so for the common stock, right, so we're receiving cash totaling 10,800. For common stock at par, right, I'm issuing out 375 shares. This is going to be 375, and my common stock has a par value of $10 per share. So my additional paid-in capital common stock is going to be 4825.53 minus 3750, or 1075.53. Okay. So for my next one, preferred stock at par. So for my preferred stock at par, the preferred stock has a par value of $50. So this is going to be 50 times 100, or 5,000. So the additional paid-in capital preferred stock is going to be 59.74, which is the amount that I'm allocating beyond the par value, or approximately 974. So again, how did we get these numbers? Well, the 3750 is going to be 375 shares times $10 par per share. The amount that I take to additional paid-in capital is going to be the allocated amount of 4825 minus 3750. For the preferred stock, this is going to be 100 shares at $50 par value per share. And then the additional amount I'm taking to my, basically to the allocate, to the additional paid-in capital, is going to be 5974 minus 5,000. So that's how I'm going through and determining that. Let's go ahead and go to number 4. I issued 200 shares of common and 50 shares of preferred for equipment. The common had a fair value of 16 per share. The equipment has a fair value of 6,500. So in this case right over here, I think what we're going to have to kind of say to ourselves is that we don't know what the value is of the preferred stock. So what we're going to go ahead and do is we're going to first go ahead and say, okay, the equipment over here for number 4. Running out of room. Let's see what we can do here. Let's go ahead and move these guys over. Okay. So for number 4, I'm getting equipment. The equipment's going to be valued at 6,500. Now I know what the common share market value is. So let's go ahead and say common stock at par, additional paid-in capital, common stock. So I can kind of say over here that, well, my par value is going to be 10 times 200. The additional paid-in capital, because it's selling for 16 per share, is going to be 6 times 200. Okay, so let's go ahead and break this down. Okay, so I've got 200 shares of common stock at 16 per share. So this is a total of 3,200. Okay, so I'm going to go ahead and assign this to 200 at 10, and then this is going to be 3,200 minus 2,000. Okay, so now not done yet. Over here, I've got a total debits of 6,500, total credits of 3,200. So what I'm going to go ahead and do is assign the rest of it. I'll go ahead and start out with my preferred stock at par. I gave them 50 shares of preferred. So this is going to be 50 times 50 or 2,500. Okay. So the difference here in terms of now looking at this. Okay, so I've got 6,500 and 5,700. So I'm going to need a credit over here of 800, which is what I'm going to put into additional paid-in capital common stock, additional paid-in capital preferred stock. So again, this is just essentially the excess in terms of what I'm going through and doing over here, but it's essentially what I need to go through and to balance. So that's how we look at this part over here. Again, we're assigning value to those items that we know first. So I want to thank Wiley for allowing me to continue to use their solutions. Who knows how much longer it'll last. Don't forget to like and subscribe. And if you would like to see other video solutions, please feel free to ask for them in the comments. Look forward to seeing you on the next video, and I will have a great rest of your day. Have a good one.